Welcome back to the deep dive. Today, we're digging into a whole stack of sources, and they're all pointing to the same thing. The global market is basically stalled at this really crucial crossroad.
Usually is.
Our focus today is that deep tension, between the future of tech and the immediate, very real demands of macroeconomics.
Right.
Okay, let's unpack this.
Yeah.
The core question right now seems to be whether this dizzying investment wave into AI, this trillion-dollar capital expenditure, can it actually sustain the bull run?
Or if market caution is just going to win out
Well-
and the timing is, well, it couldn't be more critical.
Right, because the next few days are anchored by two massive catalysts. We've got Nvidia's earnings and that key U.S. jobs report.
Huge.
And you can feel it in the market. We're seeing caution, but it's not panic. Equities are broadly flat. The S&P 500 and NASDAQ have some modest gains, but the Dow is, essentially neutral. It feels like everyone is in hold fire mode.
What's fascinating here is just how binary this setup truly is. This isn't about small fluctuations. We are watching a pivotal moment. The S&P 500 is literally testing its 50-day moving average as we speak.
And for anyone who isn't, knee-deep in technical charts all day,
Right.
the 50-day moving average, that's that key short-term trend line the bulls absolutely have to defend, right?
You have to. So if we get reassurance from those catalysts, Nvidia delivering the jobs data saying, hey, soft landing is still on, then the 6-month uptrend just reasserts itself.
But the downside is...
But if there's disappointment, our sources are very clear. We could risk a much deeper derating of all those mega-cap growth stocks. And I think fundamentally this whole AI trade is moving from narrative to balance sheet.
And that transition to the balance sheet, that's where this whole structural change gets really interesting. For decades, big tech was defined by that asset-light software model. High margins, almost no physical infrastructure costs.
The dream model.
The dream model. And now AI is just flipping that script completely.
Oh, really?
They're moving into something that looks more and more like traditional.
Heavy industry.
Heavy industry, requiring massive recurrent capital expenditure. And that means rising leverage, a huge reliance on bond markets to fund it all.
Right.
So given that shift and the high-rate environment we're in, how are the sources weighing that increased credit risk? Are we moving from valuing these pristine balance sheets to underwriting future tech debt?
That is precisely the tension. It's the whole ballgame for investment analysis right now.
Right.
And the debt figures are, frankly, staggering.
Like what?
Well, you see Microsoft's cash as a share of its total assets. It's just dropped sharply since 2020. Why? Because they're deploying capital everywhere.
Right.
Meta just issued a huge $30 billion bond to finance its data center build-out, and Amazon's back in the U.S. bond market, raising about $12 billion for infrastructure.
Wow.
The implication is profound. Investors aren't just buying growth anymore. They're being asked to underwrite the durability of a, trillion-dollar capex cycle.
So you need a whole new playbook.
A whole new set of metrics. You can't just rely on legacy free cash flow anymore. You have to pay way closer attention to capex efficiency, how they're deploying debt, and critically, remaining performance obligations.
Okay, wait, can you quickly define that? What are remaining performance obligations, and why are they suddenly so important?
Absolutely. So RPOs, that's what we call them, are essentially the revenue a company has already been paid for but hasn't delivered yet.
So it's future guaranteed income.
Exactly. In the past, free cash flow, or FCF, was the North Star. Now, because these companies are sinking billions into upfront AI infrastructure, investors need to know that pipeline is guaranteed. RPOs are a measure of that long-term contract health. It's the proof that justifies the current massive spending. This is the new, very costly industrial big tech era.
And this intense capex wave, it's not just changing big tech's finances.
No, it cascades down. It's completely reordering the entire market of who the winners are. Initially, everyone focused on the obvious beneficiaries.
The utilities, the turbine makers.
The utilities, traditional turbine makers, yeah. Because AI needs just massive amounts of power.
Of course.
But our sources are highlighting a major pivot. And it's largely driven by this trend called BYOP.
BYOP.
Bring your own power for data centers.
Why is that happening?
Because implementing new data centers has to happen way faster than the local grids can modernize or get through regulatory approval. No. You have grid instability and just the sheer speed of implementation pushing these hyperscalers to find their own solutions.
So the second-order beneficiaries are the companies that can help big tech become its own micro-utility.
That's it, exactly. The focus is shifting to companies that offer decentralized power generation, We're looking at engine makers, specialized fuel cell providers, and even, and this is fascinating, traditional oil services firms.
Oil services firms, how?
They're repurposing their existing turbine tech, the stuff they built for oil and gas.
Yeah.
And they're using it for rapid power generation for these hungry data center campuses. It's a tech pivot that has nothing to do with software.
That brings us squarely to the broader energy context then. If big tech needs this massive, dedicated power infrastructure, the energy market is facing this huge duality.
A real split.
On one hand, you have policy, climate constraints. Investors are being asked to underwrite a rapid global energy transition.
Right.
But at the same time, the sources are confirming that the old system is proving exceptionally sticky. We're seeing projections, like one from Goldman, suggesting that oil demand might actually grow through 2040.
Far longer than anyone expected a few years ago.
It's far longer. So investors have to underwrite the transition and the maintenance of the old system, basically forcing capital into two competing systems at the same time.
It's a huge challenge.
So while big tech is literally reinventing the energy grid for its future, let's turn our attention to the immediate pressure point, the consumer. How are inflation and higher rates forcing them to reinvent their own spending habits?
Well, the consumer adjustment is happening right at the checkout counter. We're seeing a profound shift in grocery habits. U.S. grocers are quickly adopting the very successful European-style private label model.
So store brands.
Exactly. Discounters like Aldi and Lidl are just aggressively gaining market share because they offer really high-quality store brands. And the giants like Costco and Walmart, they're using their own store brands not just for revenue, but as leverage, as an active negotiating tool against the national brand suppliers to keep costs down.
But this isn't just about finding the absolute cheapest item, right? The data suggests consumers are trading down on price, but they want to preserve the volume, the experience.
That's the smart trade down concept. Consumers are showing real sophistication here.
How so?
They're finding cheaper alternatives that still deliver a premium feel. It lets them stretch their dollars without feeling like they've actually sacrificed quality. They're hunting for value.
And the secondhand market is a perfect example of this.
A perfect example of a microshift becoming massive. Tariffs and inflation, they push consumers toward resale. But it's AI that is supercharging it into a scalable, high-margin business.
How does AI play such a critical role there in resale?
Because the biggest bottleneck in resale used to be sorting, authentication, and pricing. It was a huge manual effort. AI-driven sorting and predictive pricing tech, it just removes those bottlenecks. It can accurately price and rapidly categorize millions of items, turning what was a niche, low-margin consignment business into a mainstream logistical operation. It gives consumers a reliable way to save money.
And that focus on the consumer wallet and the general strain on household budgets brings us to something critical but often overlooked, a structural issue in retirement savings.
Something that flies completely under the radar.
Right. Our sources point out that millions of American workers are leaving behind these small 401k balances every single time they change jobs.
Happens all the time.
And critically, these smaller, neglected accounts often get rolled automatically into low-yield, safe harbor IRAs.
And this is a massive issue. The consequence of that inaction is huge. When you're automatically moved into one of these default IRAs, they're designed for, basic safety, not for growth.
And they have fees.
They often hold high administrative fees relative to the small balances. And those fees silently and steadily just erode the account's value. Investment growth can stall or even go backward over time.
And the cumulative impact is
enormous. It's a structural drag on household wealth creation that is totally invisible in the headline savings rates or stock market data. But it's materially slowing down the compounding of wealth for a huge part of the working population. The failure of portability, this default mechanism, it's like a slow leak in the retirement system.
So the takeaway for you, the listener, is just a powerful reminder.
It's vital. Account portability, proactively managing those small, neglected accounts. It's vital. They might seem insignificant now, but fees and low yields can materially reduce your long-term retirement outcomes. It proves even small administrative details can have gigantic economic consequences.
So bringing all these complex threads together, from big tech's debt to the consumer's savings, the core tension seems really clear. The market needs AI companies to prove actual monetization, not just colossal capex headlines. The macro data has to validate our soft landing hopes. And consumer brands, They have to defend their margins against this really sophisticated smart trade downtrend.
Yep.
So what does this all mean for the immediate future?
It means we are completely fixated on those two financial anchors we started with, Nvidia and the jobs data.
Right back to the start.
Right back there. But beyond those immediate events, the deeper structural watch is on tech debt and credit spreads. We're monitoring precisely how much extra yield the bond markets now demand to underwrite big tech's borrowing, because higher borrowing costs will eventually slow the pace.
And that leads to the final provocative thought you should keep in mind.
If big tech's dramatic move toward a capital-intensive, heavy industry model proves to be durable, if it really demands all this debt and constant infrastructure build-out, will the market eventually start valuing these giants less like nimble, high-growth software leaders?
You're more like, what?
More like utilities. Stable, high debt, maybe regulated entities with predictable, but perhaps much slower growth. And if that happens, how profoundly would that fundamentally change the entire leadership structure of the S&P 500, which has been dominated by that asset-light model for so long? That is the structural risk hidden in this week's numbers.